Hopefully everybody can hear me clearly this morning. If there are any issues in relation to audio or in relation to the slides, please use the chat function available there. The last session, we had some really good questions came out of it throughout the presentation. So I have a screen set up over here to my left-hand side where I can view any questions coming in real time. And if I can answer them, I certainly will do so here this morning. And if I can't, obviously I'll endeavour to get back to the relevant parties as quickly as possible. Again, just some housekeeping. The slides will be made available with the audio. There are some downloadables as well that we'll make available as part of the presentation. So if you want them, great, and if you don't, that's also fine. So to get started straight away, so this is the second in the presentation in relation to the mortgage, the area of covering mortgages. This morning, we're going to talk about the mortgage process and try to give people a better understanding of what's involved if you do go about buying a property, whether it's your first time or second time to buy that home. Okay, so where I'm going to start, however, is just to give a little bit about Symmetry Financial. So obviously, I'm coming to you from a company called Symmetry Financial Management. We're a bespoke financial advisory firm. We're independent, although we're not able to use the term officially. We probably more relevant. The more relevant term will be we're impartial. So we provide impartial advice to our clients on all elements of their financial planning. And this morning, obviously, will be the main focus will be on mortgages. The company is only trading just under 2.5 years. We split from a previous company in 2018. And as part of that previous company, we were the mortgage broker of the year in 2017. So just to give a little bit of background to individuals, we do have a very good idea what we're talking about. Okay, so in relation to this morning's presentation, what I'm going to talk about is giving you a better understanding of how the mortgage works. What I'm going to do there is I'm going to show you how mortgages work. I'm basically going to go straight into a calculator. Now, it is our own proprietary calculator, but there's plenty of options out there, again, which we can make available to individuals. We're going to go through the mortgage process. We're going to talk about buying a house, so what is involved. If you haven't gone through it before, it can be a daunting process, especially if it's your first time. Maybe you're listening this morning, or you're listening later on, and you already own your own home and you're interested in moving. So what's involved if you are considering moving? What is the Help to Buy? Again, that's more specifically for the individuals who are first-time buyers and are considering buying their first home, and costs associated with buying or moving. So again, I'm going to cover most of this throughout the presentation at different points. It's not necessarily in that order, but they're the main points and the main themes that I want to cover off. I have made some changes to the presentation. I'm on the clock here, so I've given myself 45 minutes with X number of minutes at the end for questions. So again, feel free to use that function. However, if I do run over, I have areas where I can cut it short, and if I have time at the end, I have a couple of extra slides in at the end, which we can use as well. Okay. So we're not even finished 2020. We're 9 months in, and it has been a year to remember. So I think we'll be looking back on the year 2020 with hindsight. So 2020 vision and all those jokes that have been flying around. But from a property point of view, and in relation to this presentation, what has 2020 thrown up for the property market in Ireland? How has COVID impacted the market with unemployment as high as 30% at the last lockdown? So we're currently post-lockdown and pre-lockdown. So obviously we had extremely high unemployment thanks to government intervention. People weren't queuing up on the breadline, and there wasn't a recession or a depression in the country. Obviously there's the next few weeks we have to look into, but what has it meant for the property market as a whole in 2020? Okay, so some very, very interesting facts coming out, and these numbers will be up to the end of Q3, so up to the end of September 2020. Okay, so house prices have made a significant recovery. So there was a small downturn in property price values at the end of Q2. So we obviously had the lockdown, which fed from April, May, sorry, March, April, May, and even rolled it into June, that obviously had an impact on property prices because there was no activity. So estate agents weren't shut, property wasn't moving. Building construction industry was obviously on hold as well. So that obviously had an impact. But since then, so over the last 3 months, we've had a significant increase in the prices of property nationwide. Okay, so and I'm going to go through it. I'm actually going to go through it province by province because obviously I'm assuming most of the listeners will be Dublin or Leinster. However, from last fortnight's presentation, there were a number of people listening in Munster as well, and I'm from Connacht, so I'm biased towards the west. So in terms of property increases, Dublin saw an increase just under 3%, June to September. The other 4 cities around the country saw an increase of just under 10%. So that was a significant increase when you think of Galway, Cork, Limerick, Waterford, that there was a significant increase in the purchase price of property within those 4 cities. And in the country, on average, outside of Dublin again, saw an increase on average about 5.8%. So just under 6% of a jump. Okay, so any drop off in Q2 was more than reflected in the increase in Q3. So what's the reason for this? So why are we seeing a jump in property prices? Is it that you've gone back to work and your employer has all of a sudden bumped up your wages and you're earning 10-15% more than you were 6 months ago? Unfortunately not, possibly not for everybody anyway. It's really down to one thing or 3 things. It's down to supply, supply, and supply. So ultimately, there are not enough properties in the country to match the demand that's driven by people who are looking to invest or purchase property. Okay, so just to put that into context, we're at a 14-year low in terms of product or stock available on the market. Was just under 17,700 on the 1st of October. That's as low as it has been since 2006. So really what needs to happen here is the stimulus, and what has come out in the budget from last week about significant investment in the property market, that needs to be escalated and sped up at a significant rate to have any impact on where we're at right now. Again, these are very small figures. I'm not sure if you're looking at this on a small tablet, you won't see it, but again, you will get access to the slides. But basically what it's trying to do is show you nationwide, obviously Dublin is isolated, which comes next, showing you nationwide the average asking price year on year, the average asking price of a property and the movement year on year. So there are only 5 to 6 areas within the country that have seen a negative movement on the price of property. And really only one of those has seen any significant move downwards year on year, and for some reason that's Clare. So anybody that has specific regional knowledge of Clare might be able to shed some light on that, but with the exception of Clare, everywhere else is more or less flat or has seen a significant increase. Okay. When you look at Dublin then, again, assuming that a significant percentage of the people listening will be Dublin-centric or Dublin-focused. So when you're looking at the average purchase price, average listed price, and then the percentage change year on year, you can see it's moving anywhere from just under 2% up to 3% in the city centre. So the demand is still there. So what people may have been suggesting in that there's a move towards urbanisation, a move towards people relocating out of the city, that hasn't been reflected yet in terms of property prices in Dublin and the other 4 cities, as I've just mentioned. To put that into context, and what I've included here as well, again, this is all courtesy of Daft, what I've included here as well is the quarter-on-quarter change, the year-on-year change, and then the change since the trough. So since basically the market was at its bottom, and now we're in the recovery. So where the property price is since the recovery started in 2013, 2014. Supply in Dublin is down 25%, which obviously is going to cause an issue in terms of valuations. Okay. In terms of Leinster, again, we're seeing the same trend. Supply is down 37% in Leinster, which again, if you don't have enough stock available, then there's more people bidding. And again, assuming people are in a position to buy, there's going to be more people bidding on a smaller supply of property, which ultimately is going to drive up the prices. Okay, so just to put it into context, again, supply is the main issue in Leinster. In Munster, we're seeing the exact same thing. Again, increases year on year, increases quarter on quarter, with the exception of I mentioned Clare there. Supply is down 35% in Munster. So again, the builders need to build, and transactions are down just under 5% over the 12-month period. And then over to our friends in Connacht, and we include Ulster here as well, as in Donegal, Cavan and Monaghan. We are looking at the same thing. Supply is down 32%, and again, transactions are down just under 7% year on year. So the main message coming out of this is, if you are looking at buying property, is you aren't going to be going looking at houses on your own. There's going to be a queue of people. If you've already been looking, then you will have experienced this. Okay. So how do mortgages work? So what is actually going on when you apply for mortgage? So let me take you through an example of a mortgage product. Okay. So let me just bring up the calculator. Okay, so this is, I'm going to sit down for this. So this is a mortgage calculator. So I'm going to put in the average purchase price of, let's just say 300. Okay, so if I'm going to buy a property for 300,000, yeah, and then the average interest rate. Now, the interest rate that you'll pay, we covered it last week. If I have time at the end, I'll touch on it. But the interest rate's dictated by the bank, and it varies from anywhere as low as 2% to as high as 4.5%. But a good average there will be, let's say, 2.5%. The typical term, I'm just going to put in there 30 years. So if you took out a 30-year mortgage, 300,000 euro mortgage over 30 years, and the interest rate at the outset is 2.5%, this calculator does allow us to amend that interest rate into the future. But just for today's presentation, I'm going to imagine that the interest rate never changed. The house value, let's say, is 330, let's say 335. So you've taken a mortgage of 300. So estimated how you have property tax on top of that, house insurance, and you have life insurance. So, it's not just the mortgage you're going to be paying there. You're going to be paying these additional costs. So the real cost of that property is in the region of 1,300 euros a month. Okay. What I want to show you, however, is how that mortgage works. So let me just bring that back to zero. So that 300,000 euro mortgage is going to cost you 426,000 over the 30 years. If you took it out over 35 years, it's going to cost you 450,000. So the more term you add, the more interest you pay. So just to show you, obviously the repayment goes down. So the repayment there went from 1,185 to 1,072, but the interest you pay increases there by just under 25,000 euros. And obviously, if you can go as low as 25 years, you're going to take another 24,000 euros off the interest that you pay to the bank. So ultimately, while the benefit of going for a longer term means that the repayment figure here is going to be lower, ultimately you'll end up paying significantly more to the bank. Now, not everyone can avail of the shorter term. Okay, so just to show you how the mortgage works, the magic word for mortgages and how the interest works is called amortization. So the interest is loaded on that mortgage, and you pay the majority of the interest at the outset. And just to put that into real figures, if I take out this 300,000 euro mortgage over the 35 years there, in year one, so this is my repayment figure. Okay, this is the interest that the bank are charging, and this is the capital repayment. So that's the mortgage loan outstanding. So 300,000 at the end of year one will be just under 295,000, 294,568. I would have paid in the first 12 months. I would have paid 7,438 euros in interest. So let's just call it 7,500 euros worth of interest. So the bank in year one makes 7,500 euros worth of interest on me, and my principal is just under 5,500. Okay, so what does that look like at the end? I have to keep going down here. So at the end, in the last year, in terms of interest, so what the bank are going to make from me in year 34, they're going to make 172 euros. So year one, they make 7,500 approximately. In year 34, they'll make 172 euros. And in terms of capital repayment, in year one, you paid 5.5, I think it was, and in year 34, it's 12,500. So there's a switch, or there's a transition over that 34-year period. There's a transition in terms of how much interest you're paying the bank and how much capital you're paying off the mortgage. Okay, so hopefully everyone understands that. This is where we spend most of our time when we're going through a mortgage application with a client, so they understand this. Now, not everyone, as I said at the outset, can afford to go for a shorter term. Okay, it's more common that people will go for the 30 or 35, but you can achieve the same thing. So let's imagine that every 36 months, you decide to make an extra payment, okay? And we repeat that every 36 months. So if in this example, you were able to afford to pay, let's say 3,000 euros, so 3,100 euros, which is the equivalent of paying 13 months a year. Okay, so you pay an extra 1 month for each of those 3 years, so it'll be an extra 3,300, pardon me. And you did that every 3 years. That would bring your 35 years down to, the magic date over here is 31.08, so just over 31 years. So by making that small payment, which is the equivalent of paying 13 months a year, you've taken 4 years off your mortgage. Okay, you've had the benefit of saving in interest, the equivalent of 18,043. What's really important here, however, is if you do make any additional payments, whatever that figure is and however often you do it, it's really important that you keep the mortgage repayment the same throughout. So if my mortgage repayment is 1,072 and I pay, for argument's sake, I get a bonus through my job, or I've just had shares and I can sell my shares and there's no interest rates with the banks, so I've got 10,000 euros there, for argument's sake, between myself and my wife. What should we do with it? Should we pay it off our mortgage? I remember a presentation where a young fellow was saying, or maybe not so young, a young fellow was saying, I should be paying a chunk off our mortgage whenever we can afford to. That 10,000 euros, and let's just say you only did that once, that 10,000 euros would have the benefit of taking just under 2.5 years off the mortgage. So if you only ever did that once throughout your mortgage career, it would have the benefit of taking bringing your 35 years down to 33.33. Okay, that's a tongue twister. It saved you an interest equivalent of just under 12,000 euros. So the sooner you pay the money off a mortgage, the more you save over the following over the months that are remaining. Again, assuming that you're very clear that overpayment is to come off the balance of the principal outstanding and not to reduce your monthly repayment. If you reduce your monthly repayment as a result, then the benefit to you has been negated. Okay, you might receive an inheritance, whatever the case may be, where the money will come from. If you only did that once, so paying that 10,000 at the end of year 3, you can see the benefit. If you paid that at the end of year 30, the savings to you is 34 years has been reduced down to just 35 years has been reduced down to 34.17, so 34 years and 2 months. So the benefit isn't the same, whereas the previous example was over 2.5 years. So, and the interest saved is just under 1,200 euros, whereas it was almost 12,000 euros by paying it in year 3. So it's just to be aware of the fact that not only is it important to overpay the loan, it's important when you make that payment. So the sooner in the mortgage cycle that you make that payment, the more advantageous to you. Hopefully everyone got a little bit out of that. In terms of reviewing a mortgage as well, switching mortgages, we'd always recommend that you review it every 3 to 5 years to make sure that you're getting the maximum on this. Not every bank will allow you to overpay throughout the mortgage. Some banks have different rules than others, but it's just that you are aware of this. It's in the back of your mind. If you are going to be entering into a mortgage process, that you are thinking, okay, what is the option available to me when that money lands into your bank account? Okay, so let's keep it going. So the mortgage process then, so what's involved in the getting mortgage ready? So I'm going to be taking you through the process of buying a house in a moment, but just to kind of put it into context, the number one thing that you have to look at is your incomes. So what are you earning, and is it enough for you to borrow? We have this conversation. It might seem naive, it might seem silly, but just given our experience, clients are always asking what's the maximum they can borrow. Okay, so the only way, if whatever the figure is, so if the multiple of 3.5 isn't sufficient for you and or your partner or wife or husband, then the only way you can potentially borrow more is to earn more. Okay, so there's no magic wand that you can wave to enhance how much you can borrow other than earn more money or set your expectations lower. Again, I have this conversation at least once a day. So once you're aware of the amount that you can borrow, the most important thing then is to make sure that your finances are in order. You do that by saving. So again, it sounds very simple, but saving actually means you're putting money into an account that you don't touch. So if I say that I'm going to save into a savings account, it's really important, and if that's for the mortgage, it's really important that you don't dip into that savings for miscellaneous, Amazon shopping, Christmas shopping, obviously, and under normal circumstances, nights out with the girls or the lads, a sneaky holiday with friends, for example. The savings have to average over a 6-month period, ideally more, but over a 6-month period, we average out how much you've been saving, and the bank use that for repayment ability, or repayment capacity. But again, it's really important that saving is one of the core elements of applying for a mortgage. Okay, obviously, if you're paying significant rent, it can be a little bit harder to save, but it always starts with the big word, the big B word, which is budgeting. Calculating how much you need to borrow. So what is the purchase price of the house you're targeting? If it's a new build or if it's a second hand. So if it's new build, you potentially will have paid the tax. So for the Help to Buy, which I'll cover in a few moments. And if you're a second-time buyer, it's a little bit more draconian in that they're now looking for second and subsequent buyers to have a 20% deposit in place. So it can be difficult. Keeping a record of all your information, I'm not going to say that's of high importance. It's more that you're aware of it. So it comes back to what I was saying already in terms of savings. It's how you spend your money, being aware of how you spend your money, and making sure that your habits, which leads on to the next point, you've got good habits. So there's no gambling going on there. There's nothing. Basically, you are allowed to live, but try and do nothing in excess. That's probably a good point. That there's nothing jumping out that an underwriter, when they're reviewing your financial documents, which is what they do, they basically go through line for line your financial records. It's that there's nothing jumping out that would cause alarm for them. Okay. Where's your deposit coming from? So is your deposit coming from the Help to Buy? Are you getting a gift? Are you getting an inheritance? Or is it all coming from your own savings? Okay. So again, different elements and different answers to those different scenarios. Looking at all the various lenders, obviously we'd be an advocate for the broker market, seeing as we are a broker. And why is that? Because the broker should be a one-stop shop for all the various banks and all the various options that are out there, even if they're not able to provide the biz or to transact the business with that particular institution. So, for example, not a lot of brokers will have agencies with Avant Money. Not a lot of brokers will have agencies with Bank of Ireland. And not a lot of brokers will have agencies with Ulster Bank. Okay, so it's in relation to what is the best product available at that time for you, and obviously you'll only find that out by asking the relevant question. You can obviously do this yourself by going into 2 or 3 different banks, but it can be somewhat easier to do it from the comfort of your own home, sitting on the couch, forwarding a few emails. Okay. Once everything has been identified, once all documentation has been collected, then you're looking at the product. So what most people do is they walk into a bank, and once you've walked into a bank off the high street, your decision has already been made. You've decided that you're going to go with Bank A, whereas a broker, if they're doing a proper job, should only identify the bank with you once they've done an assessment on your financials. Okay, so it's kind of done in the opposite way, but what we would advocate is the right way. Other elements then is you need to have house insurance in place, life insurance in place. Obviously, you need to have a solicitor to look after the legals on the contract. Again, all of which I'm going to cover now in a second. Okay. So the purchase process. So let's get into it straight away. So the first thing you have to do is collect your documentation. So that comes back to what I was saying earlier about keeping your accounts healthy, keeping your accounts in good nick. Okay. So you really only need to have it for 6 months. Okay. For second and subsequent buyers, some banks only look for 3 months. So it's not like you have to put your life on hold for forever and a day. It's basically a 6-month process if there are issues that have been identified on your bank statements that need to not show up at the point of application. The issue I would highlight here is if there are issues that show up in your bank account and you go and apply to your own bank, which most people will think is where they should start, that bank that you're applying to have visibility of what the transgressions may have been in your recent past, whereas Bank B, who don't hold your bank accounts, won't necessarily see what the transgressions are. Okay, transgressions were. Okay. In relation to collecting the documentation, again, we can make this available if it's of relevance or if it's of interest. Our checklist will cover all the banks, but in essence, it's your ID, it's your bank statements, utility bills, saving statements, credit card statements, loan statements. If you're a non-national, your stamp, If you're separated or divorced, or a copy of a legal separation agreement. We'd always recommend, if you have any borrowing in the past, we'd always recommend you order your ICB, which is icb.ie, and the Central Credit Register. I'm not sure about their website, but again, if it's of interest, we can make it available. We have a little guide to explain how you can order your Central Credit Register report. Slightly more complex, although it's not really. It's just some people might find it a little bit more complicated than ordering your ICB. The CCR is the go-to credit report of the industry now. The ICB is a thing of the past, really. Okay. The amount of documentation, as I said, it varies from bank to bank. The amount of pay slips varies from bank to bank. If you're self-employed or if your partner is self-employed, the information required for a self-employed individual varies from bank to bank. It's anywhere from 1.5 years trading accounts up to 3 years trading accounts. And in terms of PAYE, it's anywhere from the last 2 of the last 3 pay slips up to the last 3 months pay slips. So if people are paid weekly, fortnightly, monthly, you can work that out then yourself. Okay, you need an income cert or a salary cert completed by your employer. Other things that can vary, can cause complications here. If you have fluctuating payments, so if you have bonuses, commissions, allowances, share options, all of these things can complicate what income is calculated or what income is assessed by the relevant bank. And believe it or not, every bank have their own rules. Okay, so there's not one rule or one rule applies to all. Again, another example on that, if you happen to be married or partnered with somebody in the public sector, there are 2 banks out there in particular who will allow the public sector individual to borrow more based on their salary scale, which again is a nice little touch if what you're borrowing under your own salary salaries aren't sufficient. Okay. Once you've collected all the documentation, and that's generally done electronically, so in terms of bank statements, loan statements, it can be done by post, but it's generally easier electronically because the documents are all electronic nowadays. Then you meet. In our scenario at the moment, most of our meetings are e-meetings, so we're not doing too many face-to-face meetings. I would imagine it's the same across the board, but it's more for your convenience than anything else. So meetings can be transacted at 6, 7 o'clock in the evening after work. You don't need to be worrying about taking time off or getting in your car, driving down to the relevant bank. And it's just as efficient and just as effective by sharing the screen and going through the application process with the individuals. Okay. Now, once you've started the application, you're either at approval in principle stage or you've already started looking. So again, I covered that last week, and if I have time at the end, which doesn't look like I will, I can touch on it again. So you're looking for a house. So then you're basically going shopping on Daft, you're on My Home, you're on your local estate agents, depending on where you live. And if you're lucky enough with the bidding process, you then go sale agreed. And it's at that stage you put down a booking deposit, and the booking deposit is a refundable deposit. We typically ask for a copy of the booking deposit, which you should also look for, and believe it or not, oftentimes isn't forthcoming. You have to ask for it. Varies again from estate agent to estate agent, but I would highly recommend you ask for a copy of the booking deposit. So I've handed over 5,000 euros. The least you can do is send me a document to confirm that you've received the 5,000 euros. Again, let's just put it down to lapse of mind and not say it's laziness. A tip I have included here is you cannot view too many properties, and I really do mean that. How do you know what's going to be right for you if you don't go and look at enough properties? Obviously, in the current environment with COVID, it's slightly harder, but a lot of the estate agents now are moving online with videos as well, 360 videos, etc. You can still do drive-bys, again, subject to the new, I don't want to be getting anyone in trouble with the new COVID guidelines or the new COVID restriction guidelines, but you cannot view too many properties. You might go and view 30 or 40 properties, and it's the 31st property or the 41st property that you view that's the one you want to live in. Or you may view 40 properties and realize it was the first property that you viewed is the one that was for you. But you really won't know what's right for you until you start looking around. Don't just settle for something that you feel it's okay, it'll do for now. Really, I would really encourage you, if it's a house to live in, that you try and buy something that you know you're going to be comfortable with for at least the next five plus years. Okay. Once you've gone to this stage, we'd always recommend you carry out a structural survey. Why carry out a structural survey? Unless you're in the building trade, you've got the engineering qualifications, or your partner or somebody in your family has the skills, I'd recommend you get a survey carried out to ensure there's nothing you're missing. Okay, so dampness, subsidence, pyrite, flooding in the area, etc. So things that you may not consider: cracks in the wall, what's going on in the attic. Loads and loads of examples I can give you that come out in surveys from clients over the years that have caused them either to get a reduction in the purchase price, which is a nice thing, or to pull out of the property purchase. Typically, a survey shouldn't cost you more than 300 to 500 euros. The valuation, which is on behalf of the bank, they're all fixed figures. The valuation fees are generally 130 to 185, and again, it varies from bank to bank. That is a prerequisite, and it is a requirement for the bank. Whereas the survey is something that is up to yourself. If you're buying a new build, it's not called a survey, it's called snagging. And again, buyer beware. A lot of the developments will provide a snagger on site. I have my reservations about availing of these services. I generally would recommend you look for your own professional service provider for the snagging as well in a new build scenario. Okay, so hopefully there's some takeaways there for you. We're moving along in the process now, so we're actually at loan offer stage. So the contract with the bank is now issued, so the valuation is back in. The bank issue out the contract for the loan to your solicitor. At the same time, you're the solicitor acting for the vendor. So when you've gone sale agreed in step number 2 there, you've given your solicitor's details to the estate agent. They pass them on to the seller's solicitor, and the seller's solicitor then draws up the contracts for that property. If it's a new build, it's the first time. And if it's obviously a second build, contracts may have to be, or sorry, title and deeds may have to be recalled from the relevant bank. But again, this process is called conveyancing, and it's looked after by your solicitor. Okay. Again, what's important here: don't overpay for conveyancing. I have seen absolutely astronomical charges for conveyancing. A young couple buying in Clontarf were being quoted a beautiful property in Clontarf, but because it was Clontarf and it was a higher price point, the figure was 3,000 plus VAT for the conveyancing fee. So that's on top of stamp duty, which in their case would have been just under 6,000 euros, and all the miscellaneous costs which are listed there. Might be hard to see in that slide, but you have your conveyancing fee, which shouldn't be any more than 850 to 1,200 plus VAT. You have all the miscellaneous costs, so photocopying and postage. You have outlay, searches, stamp duty, which is the 1%. The property has to be registered with land registry. Then you have declarations, which is commissioner votes, and then folio printouts. So all in all, this example here of a purchase of 280,000 euros, including stamp duty, is 4,980. What you often find with first-time buyers in particular is the solicitor will include all of those costs in their quote, so you don't actually know what the conveyancing fee is. So you're buying a house for 600,000 euros, the costs are 12. Okay, so that means that the additional costs in that example will be 6,000 euros, so the conveyancing fee is quite high. I had a conversation with a solicitor on behalf of a potential client only last week, and the conversation ended up talking about the charge that he was going to levy, and he said he hadn't got a fixed fee structure. It was on a case by case, which ultimately told me this fantastic solicitor in a particular area in Ireland decided what he or their firm was going to charge their clients based on the deal. Okay, so who were you when you walked in the door? And openly admitting that to me as part of the conversation. Okay, so as part of the purchase process, shop around, and again, we've got panels of solicitors who we're happy to refer clients on to. Okay, you now meet your solicitor who isn't overcharging you, and you sign the contracts with the loan, which is the loan offer, which is with the bank, and the contracts with the purchase, so with the house, which is now binding. So you're now into the stage where you're buying this house. Okay, so the survey is done, valuation is done. We're now moving towards the final stages when you're going to be getting your keys. Once you know you're signing contracts, generally there'll be a closing date set. So we now know we're closing on, so let's give an example. Today I can't see the date, we're the 20th of October today. So if you're at this stage, we would be generally expecting that this case will be closing at some stage in early to mid-November. So 2 to 4 weeks, typically from this stage, but assume 4. If there are other issues that have been identified, for example, the people selling are in a chain, so they're buying a new house, it could be delayed further. Okay. Now we're into the final stages. Once we, as I said to you, once we know that there's a closing date set, you need to have insurance in place. So what I was covering off in my calculator there a couple of minutes ago in relation to the additional costs outside of just the mortgage repayment, you have to have house insurance and you have to have life insurance. So the house insurance, if you're buying an apartment, it will be part of the management fee. So there's what's called a block policy. And again, your solicitor will typically arrange to get the block policy from the vendor's solicitor, so from the people selling, they will arrange to get the block policy for your solicitor. If you're buying a house and obviously not an apartment, then you'll have to arrange your own house insurance. Most of the banks have deals in year 1. It doesn't mean that you stay with them after year 1. Again, shopping around is generally good practice. Same on the life insurance. If you happen to go direct with the bank, Irish Life do all the life insurance business for all the banks except Bank of Ireland. Bank of Ireland, the insurance looked after by New Ireland or Bank of Ireland Life. So what that means is you're missing out on the rates and the quotes from all the other insurance companies, namely Aviva, which is now Friends First as well, Royal London and Zurich, and there's one or two others that just aren't popping to mind, but you will definitely get cheaper rates and cheaper quotes with some of these other providers. It's just the way that the banks operate. They're tied in with one insurance provider. Okay. Funds now are drawn down and you get your keys. So after all of the stress and the last 3 months or however long it's taken to get to this stage, all the stress and sleepless nights, you now get your keys. So what we'll always recommend you do there is you relax and you enjoy your new home. Obviously, you're going to want to put your own touch on it, get the house into the state that you want it to be in, but take time to enjoy what has probably been a stressful scenario. Our number one motto, our number one motto when it comes to helping clients buy their house is we try to keep the stress to a minimum. Okay. So if you already own a house, so those of you that might be listening in, you already own your house and you're thinking about moving, questions you have to ask, and again, you might need to be aware of it. Do you need to sell? So are you planning on selling for the deposit for the new house, or is there enough equity in that property that you can release so you can leverage the equity you've built up over the last X number of years and maybe hold on to the house and rent it out? If you're in a chain, that can impact the purchase process. Again, what I mean by that is if you're selling and you're buying, the people who are selling to you may not select you as the preferred purchaser unless you're already well into the process of selling your own house. Because I come along to buy the house and I'm not in a chain, I've got my deposit and I've got my mortgage approval. You're coming along, you're selling your house, and we're both bidding. I'm maybe 2,000 or 3,000 euros less than you. They may opt for me because they know the deal is going to be done faster with somebody like myself than it would be somebody in a chain. So again, just something that you may not have thought about if you are in that scenario. And then equally, do you have the 20% deposit, which we touched on earlier, or are you going to need an exception, what's called a loan to value exception, where you can borrow up to the 90%? Again, that's the easiest exception to get from the relevant banks if it is what you need. Okay. What's the Help to Buy scheme? Okay, they're a little bit backwards. Again, just skipping down through it. It was launched 4 years ago to help kickstart the new build market. It's been extended now to next year, and it's basically where you get 10% of the purchase price of the property up to 30,000 euros. So if you're going to buy a house for 300,000 euros and you've paid enough tax over the previous 4 years, you could get the 30,000 deposit from the tax that you've paid. So while you might have been saving money to buy your new house, you turn around, you decide to buy a new build, the money is actually given back to you from the tax that you paid to revenue over the previous 4 years. This only applies to new builds, and it only applies to self-builds. And the maximum purchase price is 500,000, and the maximum loan to value, the loan to value has to be at least 70%. Let me word that differently. So that means if you're buying a property for 100,000, the mortgage must be at least 70,000. Okay, so this can be this can cause difficulty for new builds, because if I'm going to buy a house, more than likely I already own the site. It might have been gifted to me, for example. So it's just to be aware of that. You do have to be tax compliant. So it means that you do have to arrange your tax return, which for PAYE is quite simple. For self-employed, it can be a little bit more onerous. If a property was gifted to you in the past, we do get asked this. This is all on Revenue's website. Again, we can make the link available. If a property was gifted to you or you inherited a property in the past, then you still would qualify as first-time buyer status for the grant. Okay. Okay, so how are we doing on time? So we've got 4 minutes. So where do you start? So very quickly, you research the market, making sure you're getting the right mortgage. Again, I'm not going to go through all of this is from last week or the week before last, but it's in relation to the different types of mortgages that are out there, how much you can borrow, to what age, based on your incomes, etc. Some of the stuff I've touched on already. Make sure that you're researching the market. Make sure that you know what you're going to be repaying now and into the future. Does the bank you're applying to, do they have an overpayment option? So can you pay more than the fixed amount that you're borrowing? Cash incentives, I should touch on that, because cash incentives are here and it looks like they're here to stay for the foreseeable. So some banks offer incentives for you to apply via them by giving you anywhere up to 3% cash back based on the amount you borrow. So if I'm borrowing 300,000 euros, I may get 9,000 euros back from that bank over typically 2% at drawdown and an additional 1% in 3 to 5 years time, which does and is very attractive in terms of cash, but ultimately you will pay for that in the rate. Okay, so it's just to be aware of that. I've talked about the difference in the long term and the short term, basically how mortgages are structured. Okay. I'm not going to get into that in any great detail, but ultimately when you're buying the property, we did touch on the costs in the example there when you're shopping around for conveyancing. Okay. And then a few tips, in addition to what we've already said, is you should try and get AIP or approval in principle in advance of applying for the mortgage. So at least you know what your shopping window is. So how much can you possibly afford? What's the purchase price that's within your range? A fantastic website out there is the CCPC website, which is the Competition and Consumer Protection Commission. We use them ourselves for comparable quotes with clients, just to explain to them how the mortgage will work, not just after 3 years, but after 15, 20 years. A fantastic tool out there, in addition to our own calculator, and it's free. It's not difficult to use. How much you can borrow, again, we'll skip through that for today. So in relation to the banks, obviously there's more than 1 or 2 banks out there. Thankfully in Ireland, it's not like in the UK where there's 50 plus institutions that will lend money to you. We don't have that many, but there still are quite a number of options out there, and it's basically about trying to make sense out of what's the right option for you. This is a list of all the mortgage rates and mortgage products as of the 1st of October. So you can see that it's not a small market in terms of products. Every one of those little grids is a different product in terms of its loan to value or its term. And the banks will have particular products that at a particular time frame, they're being encouraged to sell. So why, again, what Symmetry Financial are obviously carrying out this presentation. So why would you consider us as a potential partner if you are going to go through this onerous process? Well, we represent you. We don't represent the bank. We try and break it down and make it as simple as possible for you, trying to take the stress out of it. As I mentioned throughout the presentation there, in relation to how you meet, meetings don't necessarily have to be done face to face. So since COVID has taken over, it's actually completely restructured our business for the better. We're much more efficient with our time, and as a result, we get more done. I can't talk about every broker, but we don't charge a fee for our service. The banks pay all brokers 1% of the mortgage value the month after the mortgage has issued, and we earn it over a 3-year period. We're motivated to get the deal closed as much as you are. You want to get the keys to your house. We're motivated to help you. But equally so, we're there as an ear. So yesterday, I spent 2 hours of my day talking to existing mortgage clients in relation to the process. One client is starting to get jittery knees. The couple are buying a good income couple. They're buying a very significantly priced property in South Dublin, and just in relation to the potential monthly mortgage repayments, So what I did was I set him a couple of tasks last night to make sure that it's the right property for him. So there's no benefit for me, even though you might think, well, why would you try and talk a client out of buying a property? Because our role as the broker or as the advisor is to ensure the client is doing the right thing for themselves. Okay. And in that example last night, if that client decides to buy the property, they've made that decision based on having an independent ear to talk to them about the different, to talk through the different angles and the different things that they need to be aware of. Okay, so that's the type of stuff we go through, as well as having relationships with different third parties to help you with the legal fees, the conveyancing, painting, plumbing. So I had a client on to me thanking me for the plumber who, at a drop of a hat, was able to reinstall a new boiler. I think it was done on Saturday. So we have access to individuals, same as Creative Landscapes, the landscaping company we use. Used them myself, fantastic company. Gary is the guy there. So we have access to all of these individuals, and we're happy to recommend them because we know of the service and of the way they treat our clients. Okay. If you are interested in arranging a complimentary one-to-one meeting, so it doesn't cost a penny to talk to us, go to our website. There's an option there to book a consultation. So you click it and you fill it in, or you can just email us at info@symmetryfinancial.ie, and myself or one of the team will get back on to you within the day to have an initial chat with you around what your goals are. As I did say at the outset, these slides will be made available to all participants, and I believe it's been recorded for future sharing. So that is us. I haven't seen any questions, so either I am really, really, really good today and all the questions have been preempted, which I like to think, or people have zoned out, which I hope isn't the case. And so if there's no questions come through in the next 30 seconds or so, what we'll do is we'll wrap it up, and we will call it a day. And hopefully everybody finds something. Take one or two things out of the presentation is what I would ask, and implement it then when the time is right for you to buy. The information I've gone through there, we've tried to keep it generic so that it won't go out of date. Some of the information in relation to Help to Buy may, but in relation to the purchase process, etc., most of the information and the way I've structured the presentation is that it's going to be in date in 3 months' time, 6 months' time. Again, caveat there will be the Help to Buy, because that's something that the government are in charge of. Okay, so thank you very much for logging on, and enjoy the rest of your day.